Since the 1980s and the advent of defined contribution plans and IRAs, you have been receiving statements that have come and said, here's how much you have in terms of assets. We have been trained to look at assets. As you start to prepare for retirement, I need you to understand it is no longer really about that asset. It's not the $1 million or $500,000 or $2 million account. It's the $4,000, $5,000, $10,000 a month that you need coming in on a predictable, reoccurring basis so that you can maintain the standard of living that you want. We're going to talk about the difference between assets and income on Consider This Program today. Well, good morning and welcome back to Consider This Program. I am your host, Joe Clark.
And I'm Jamie Burton.
We are plumb tickled to have you all along with us. And Jamie, happy to have you here as well. Hey, we are working on the 7 things that you need to consider before retiring. We have a checklist you can get right off our website at yourlifeafterwork.com, or just give us a call at 800-928-4001. Remember, if you're listening on WIBC or some of the other radio stations, you only get part of this show. So you really do want to go back, get to the podcast, consider this program. Yes, you have to type in program. Sorry. There's about 6 or 7 other Consider This shows that are out there. So it's Consider This Program. Happy to have you along. Also happy to answer your questions. yourlifeafterwork.com or 800-928-4001. Jamie is one of our senior advisors up in our Lafayette office. She's got her degree in financial planning from Purdue University and has been here with the Financial Enhancement Group for how long? 5 years?
Yeah.
It's just hard to imagine. That 5 years. Okay. Yeah. You know, we are blessed. She is one of the 38 people that we have on the team and one of our senior advisors. So we're happy to have her. So Jamie, tell me, what is the difference between assets and income, and what should people do about it?
Yeah. So, a lot of times people, they pull up a statement of their assets, and that's really what they're focusing on when they are coming up to retirement and are deciding if they can retire right now or not. They strictly look at that statement and are trying to make decisions based off of that. What we know that is, once you get to retirement, you have to be focused on how much income that you're going to need month to month and where that income is going to come from. So looking at that statement, that's really only one small piece of the puzzle. We need to figure out what kind of income is going to be coming in outside of just those assets, so we can make a plan around that statement, those assets on the statement, to get you the income that you need in retirement.
So it's one of the ways that I try to express this. I come from a farm community, so I try to teach people about this from a farm ground. You've heard farmers say, if you've been around them for a long time, that they're land rich and cash poor, right?
Yep.
And that's what happens to people at retirement many times. They have become asset rich, but income poor, dividends, interest. In fact, we're going to talk about this at one of our group meetings at the Financial Enhancement Group. Thirdly, Adam is going to go over that, how that is really the dividend distribution amount, the interest amount have all decayed over the years, and people are having a hard time getting income out. And on top of that, it's their baby, right? I mean, you've got kids running around.
Yep.
You don't want anybody to hurt your babies, right? And when the kids grow up, and we just graduated our youngest one this year from nursing school, so excited for her to be an RN now, right? But when you watch them grow up, it's very, very natural to start paying more attention to the statement, to the assets you have. You're starting to think about your life after work and what comes next. And when that happens, you become attached to this thing. For if you're my age, we've been putting money into these accounts for almost 40 years, right? And when you go to retire and all of a sudden somebody tells you can take money out, I'll tell you, it just doesn't feel natural. And that's one of the things that Jamie and the team can help you do. We help liberate people from that frustration of taking money out or not understanding the tax, but making sure that you have the income. Mm-hmm. All right, back to you.
Yeah, so when we're looking at this statement, what we say is, you have $1 million on your statement, but how is that $1 million in those accounts? Is it all tax deferred? Is it a mixture of tax deferred and Roth money and brokerage money? That makes a huge difference. If all of that $1 million is tax deferred, well, then you really don't have $1 million. You have $1 million minus the taxes that you're going to have to pay. And if you don't take that money out in a tax efficient way, that can dwindle down that account very quickly, and you're going to have less than what you are expecting to have once you get to retirement.
So for the last 20 years, I've been writing a newspaper column for the Herald Bulletin. Jamie actually helped me co-author this one. So you can get that off our website at yourlifeafterwork.com. But if you didn't understand when she talked about tax diversification, tax deferred is your 401k, your IRAs. It's where you get a deduction today, but you don't. But you have to pay all the taxes on it in the future. Plus, you have to play by the IRS's rule in the future, which we don't know what that's going to be. The Roth, obviously, you don't get a deduction today, but you don't have to pay the taxes in the future. And then, Jamie, talk about a brokerage account, because that's the one. We just had. I was with a family that had more than $1 million and didn't understand that they could put more money into a different account. They had maxed out their Roths. They'd maxed out their 401k. She's a teacher, maxed out their 403b, had no idea there was another type of account.
Yeah. So a brokerage account, you can think of it as the same tax situation as if you were to put money into a savings account. So this is money that you've already paid taxes on. You put it into a brokerage account, and then that money is invested. You get a 1099 each year for the dividends and interest and any gains that you have in that account. You pay the taxes on that at a long-term capital gain rate, or
and those are recognized gains. And this is this is important to understand. So if you bought a stock and that stock went up in value, but you didn't sell it, you have no tax from that gain.
Right.
But you will later on. And so when we talk about charitable strategies, when Jamie has a next steps meeting with you and you guys sit down for 90 minutes, it's complimentary, right? She's going to give you things to consider today, things you're going to want to consider in the future. And if we choose to partner together, what the Financial Enhancement Group will do for you, and she'll put it into writing. But part of that is going to look at what is your long-term gifting strategy? What's your long-term income need going to be? And this gets to be really, really critical when you think about your tax. You may need more income than will keep you in the 12% tax bracket or 15% bracket. If you don't have places to pull income out of at retirement that have already been taxed, you're going to be in for a world of hurt when it comes to the IRS.
Mm-hmm. Yeah, so when you have that money in that brokerage account, and like Joe said, the stock that you have bought has continued to grow and you haven't sold it, well, then you might get into a tax situation where you owe a lot of long-term capital gains. So what you need to do is think of, like Joe said, that long-term gifting strategy. Are you gifting to a church? Are you gifting to a charity? And currently you're doing it out of your bank account. Well, there's things that we can do that is much more tax efficient with those stocks or other assets that are in that brokerage account, where you can gift those appreciated assets to a church or a charity. And then the church is the one who sells it. They don't owe any taxes because they are a 501c3. And then you don't also have to pay that capital gain. So there's just different gifting strategies around having a brokerage account and money that's set aside that's not retirement income. So another big thing with a brokerage account is that you don't have to be a certain age to be able to pull from that account. You can pull from that account at any age with no penalties attached to it.
And they're great gifting strategies for kids and other people that are in different tax brackets. So so how do I look at this? Income versus assets. What's the first thing that I need to pay attention to as I get ready to go to retire?
Yeah, so you need to figure out if you are going to, what sources of income that you're going to have coming in automatically. So you need to decide, okay, I'm qualified for Social Security. At what age am I going to start taking Social Security so I have that income already coming in? Do I have any pensions that I have that's going to be automatic income that is added to my tax return once I get to retirement? Am I going to work part-time? Am I going to have that income coming in? Do I own farm ground? Am I going to have that rental income coming in? So once you figure out what we call mailbox checks that come in each month automatically, we figure out that income, then we can determine how much income we're going to need on top of that we need to replace with the assets that we have saved up through our working years.
Every now and then somebody hears me talk about mailbox checks and they think I'm saying that they're bad things. I'm not trying to tell you not to take income. What I'm going to try to tell you, and what Jamie will teach you in your next steps meeting, is how to take income the most efficiently, right? We do not know what the future tax code holds. We know what our health is today. We don't know what our future health is like. There's a lot of unknowns that are out there. And so part of our job at the Financial Enhancement Group is to help you eliminate unknowns. We want to remove any and all unnecessary risks that are out there. And so we tell people when to take Social Security based on what we know today, based on the current tax code, based on your health, based on your unique situation. It's not the same answer for everyone, but you take it partially based on how those other assets have already been accumulated and the tax diversification that you've built. So pay attention to that when she talks about it. Any last points you want to make on this one?
Yeah, another part of the 5 critical elements that we need to look at when we're looking at income is based on the income that you need above those mailbox checks. Are your assets properly diversified, and are they making the right return to where they can withstand you withdrawing a certain percentage from your accounts to keep up with your standard of living? Or do we need to look at reassigning how things are invested, how much risk you're taking in those accounts to try and get a return that makes sense for the amount that you're withdrawing from those assets?
It does surprise me. I will fess up to this, and I'm not easily surprised when it comes to this industry. But when you talk about the 3 phases of finance: accumulation, preservation, and now distribution, and that's what you have to think about at retirement time. You're able to look at your statements and perhaps figure out an average rate of return that you've received for the last 10, 15, 25 years even. But remember, that average return was based on you being there beginning, middle, and end. That's what happens in the preservation stage of finance. And distribution, when you pull money out, it's not there to be able to grow back up when a market rebounds. And so you have to prepare to take a smaller percentage for distribution than what your average return was during preservation. And many people find that shocking. I've done this for a long time. I can walk you through the numbers. It's pretty simple to understand. Jamie, Dean, Aaron, Grant, Darren, they all are prepared for this. It's part of our team. It's what we do. But go to yourlifeafterwork.com. Get signed up for a Next Steps meeting. Jamie and the team will give you 90 minutes of their time to give you things you're going to want to consider today, to prepare for that retirement, that separation of service. She's going to give you things you're going to want to consider in the future. And if you choose to partner together, she'll tell you what FEG will do for you, and she will put it into writing. We have a 180-day commitment that we are very, very proud of, so that you know exactly what to expect, how we earn our keep, how you reduce fees, how you have a better tax plan, how you have a better control of risk and volatility, and how you can prepare for an inflationary world that just seems to be out there. Go to yourlifeafterwork.com or give us a call at 1-800-928-4001. Jamie and the team look forward to meeting you. Again, yourlifeafterwork.com.